A change in the hedge risk level. We are moving it a notch, and we have good reason to do that. If you take a look at the SPX daily candle chart, you're going to see that we have a break of not just diagonal support but horizontal support, and indeed lower high, lower low, even a lower closing low. Forget the wicks, which that's real price, but obviously the fact that we have a lower closing low, we have broken down with several significant breaks of support, and that's one of the things we look at with changing our hedge risk level. And if you look at the Russell, we also have here real significant breakdowns of diagonal and horizontal support. The NASDAQ, significant breakdowns, much like the S&P, a lower high, a lower low, breakdowns of the diagonal and horizontal supports. The Dow Jones is more neutral, but of course this is 30 companies, and this one is our least important to making decisions. We primarily follow the S&P 500 in making these decisions. But bottom line is, you take a look at those, and we have a significant breakdown in the market structure. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights on current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:45 a.m. Central Time, and I'm recording this in preparation for the market day of May the 7th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's dive into the key highlights from tonight's and this morning's reports. The weakness continued through the overnight, and this leads even more credence. If we don't get a bounce and a significant, strong, with volume, healthy bounce today, we could really be breaking down. Now, we were at the bottom of a channel yesterday, but the fact that we have broken down in the overnight, and as you'll see in a moment, the overseas action has also been very weak, is not good, and certainly kind of cemented the decision to go up a level in the risk level of the market. So the S&P down about 2/3%, the Russell down over 0.5%, the NASDAQ down the most at 0.75%, and the Dow about 2/3%. Crude oil dropped about 0.2, Euro scratch, and then bonds down about 0.38. We've had this really weird relationship of late with the bond markets, not just in the United States but globally, really breaking down. Normally you look for flight to safety to bonds, especially when you've had protracted weakness like we've had in recent trading days, that people would be moving into the bonds, and you'd have TLT and so forth moving up strongly. Well, they've both been breaking down. In fact, TLT has not served as much of a hedge or a place of safety. In fact, if you look across all the typical areas where people normally pour money for safety, everything has been down, with the exception of perhaps gold. So gold, though, last night down 0.2%. So again, where is the money going other than to cash? China down 2.77%, Hong Kong down 1.27%, Japan down over 1%, Germany down 1%, United Kingdom down 1.5%. So a lot of red ink across all the overnight indicators that we look at, so that does not portend well for the bulls at the start of today. You have, with macroeconomic reports coming in, unemployment claims on the weekly variety, but more important, tomorrow you're going to have the non-farm employment change report, the monthly unemployment or employment report that comes out. That's the big one for this whole week. Other activity today, And let's see, nat gas, if you're one of the traders in natural gas. And that's about it on today. Tomorrow, obviously, the big run that we talked about. Let's see if there's anything else. That's enough. The big one, everybody will be talking about tomorrow will be the monthly unemployment report. And the market, if that comes in weak, the market could really crater. If we have on our market condition report, you'll see the short-term VIX has clearly been going up, though certainly not near an extreme by any measure. 16.05. Our IV percentiles 33, 35, 41, 47. They're just coming into the kind of the middle range. So still nothing in terms of severe fear being placed in the market. So we've had significant price weakness and even an uptick in standard deviation moves in recent trading days. And yet at the same time, in terms of premium being paid for those fears, that has yet to be realized in any significant way. These are still relatively low levels, even on the last 52-week stage. Forget about historically. So that's something to be taken into account. And while we've certainly talked about increasing in our risk levels, and we're going to talk more about that here in just a second, you still have a situation where you can't just go put everything into cash and put everything into bearish trades. This could very, very easily do a flush and then reverse and rip the heads off of the bears and take off back to the upside. And 2 days from now, you could see yourself, 2/3, 3/4 of the way back up to the top of the range, as we have seen multiple times this year. So this is a very tricky condition. So we're going to talk about a couple things to review and consider with your portfolio, but at the same time, it is not a time to just simply shut down. We have indeed had a change in the market trend intermediate term phase opinion. We've gone to phase 5, which is a breaking of support levels. And some of the traits here, we basically think of this as the in short term, the break of diagonal, the market trend breaking diagonal and horizontal support levels. You have, in your market participants, should I sell deer in the headlights? Maybe I should do a covered call or a collar. These are the kinds of things that are kind of going through the minds of the market participants at this point. Stock break support from a volatility standpoint, higher volume as the longs start to be stopped out and start to exit. You have, in terms of patterns, you start looking for bear flags and head and shoulder patterns. From candles, start looking for bearish harami, hanging mans, tombstone, doji, shooting stars. These are the kinds of patterns that could start to show. From strategy standpoint, collars on the intermediate term, perhaps bearish stock, long puts, short vertical calls, long vertical puts. High beta sectors are being probably hurt very much, and we'll look at those specific numbers. Sectors taken to the wood chip, and stopping out of long positions, and those are the kinds of things that are kind of the typical descriptions of this phase 5, or the short term, what we call the breaking of support levels. You have with our investor posture, the IBD status is market in correction. So this is an elevated risk condition, very significant into our change of opinion on the hedge risk level. Also, the GMI index has fallen to a 2 out of 6. I think that's the lowest rating I have seen since I started following that index. So that is also of concern. Active trader market posture is weak bearish. Buy long side portfolio exposure position sizing opinion has dropped to 0. So certainly not initiating any kind of bullish trades whatsoever at this point. Indeed, from a market posture standpoint, the S&P is weak bearish. If it goes below a 50, and that could happen in one day, if this drops below a 50 on weak action today, that will be very bearish. The Dow also weak bearish, but even closer to crossing that threshold. Nasdaq's already very bearish, and the Russell very severely bearish at below the lowest threshold. So market posture for the intermediate term is very, very poor across all four indices. Our hedge warning status, as I've intimated, we've raised this to a level 2. This is a red light. You have multiple reasons for this, but from the volatility-based warnings, you have market and decline and sharp increase warnings have flagged. You have, obviously, from a distribution day count, we stop counting that when we're in market and correction. That trumps everything. The VIX actually is in a daily squeeze. It's not even fired yet. If it should fire, that would lead to significantly more weakness. And look at this New York Stock Exchange new high, new low indicator. Almost 6 times as many new lows as new highs yesterday. 598. Anything over 300 is cause for concern. You had some time ago the S&P crash warning fire from our E-mini charts, and we've seen that for a while. That is not a terribly time sensitive, and we've carried that for some time, but it's still to be noted as we face these current conditions that that did fire. It just seemed to take a little while to kind of set up, as topping action often does. The intermarket risk aversion indicators, interesting enough, and this may be highly related to the fact that bonds have been acting in a very unusual way for a rollover of the market. They still are flagging risk on. You do have the consumer discretionary consumer staples ratio flagging as risk off. New opinions with our option opinion strategy. The VIX is inside the acceptable window, but consider the potential for increasing volatility. We've been talking about that. But with the market and correction situation existing, you've got to take that into account on the initiation of any new option income strategies. Probably mostly focused on managing the ones that you're in, perhaps scaling out, positioning that size down a little bit. Most definitely you've got to stay on top of them and have your decision points in place at which you make adjustments. Consider with your adjustments rolling out for a time, not necessarily always adding position size when you have a market and correction situation. But follow your rules ultimately for the strategy. But consider your option income strategies are probably going to need more tender loving care when you're in a market and correction status. Covered calls, obviously you would not initiate any new covered calls. Existing covered calls might consider shutting down, or at least taking a neutral stance and having a 2-to-1 distribution between in the money and out of the money strikes. So, protect yourself with those positions and bring in that extra premium by using in the money strikes as opposed to simply out of the money strikes. You might even consider in the money and at the money strikes, especially if we follow through and don't bounce in the next day or so. Put selling, market and correction conditions are suspect now for selling puts. Look for bottoming patterns to time when to start selling puts. Consider put credit spreads with defined risk, and consider scaling into positions. So if your normal position size is to put on 4 contracts on a McDonald's type position, perhaps you go in with 2 and then scale in the others when you start to see bottoming patterns coming in. Just kind of think about what you're doing in terms of initiating put selling. Normally when markets are weak, that's an opportunity to sell puts against a core portfolio basket of stocks that you are willing to own in the position size that you're willing to own. But you may be frankly able to put those on for some nice premiums, even lower than where we are right now if this market continues to break down. That's a big if. But certainly when we look at our sectors specific market postures. A lot of red here, not anything that's holding up well, and that certainly is the nature of a market correction. Everything goes down. You look at the percent change for yesterday. I mean, the best you could have done was consumer staples at down 0.75%. The worst, and especially these interest rate sensitive products like utilities, just getting hammered. So a lot of things going on. At a hedge risk level 2, some of the things that you should be doing: double check your alerts for key support areas that would trigger additional decision points. Double check all of your stops, whether hard stops or alert stops, to trigger a judgment call by you. Have your thoughts collected as to what decisions or strategies you might want to invoke. Be prepared should stops start to be run as to what you would do with different parts of your position. Calculate your long delta portfolio exposure. You need to know how much long delta you might want to hedge and at what percentage you might want to hedge. Have those plans in place so that they're ready to act upon, and you're not having to try to figure this stuff out in the heat of a falling market. Consider closing out any bullish swing positions. And this, remember, swing positions, those are those shorter term, meant to take days to maybe a few weeks. Review at least for tightened stops or to manage your profit management rules more closely. And then add up all your core put selling positions. If you were assigned everything that you have on, are you really ready to accept that? Are you ready to, do you have the cash ready to be able to take those shares that you said you were willing to do when you put the position on? Well, now add it all up. Make sure that you don't have an ugly surprise and at worst end up with a margin call, being forced to sell at adverse prices in order to cover the excess risk that you have in your portfolio due to your core put selling. So bottom line, are you ready? Are you really ready? And do you have enough trading capital to actually take possession of all those puts? Now's the time to ask those questions and ensure that you have a plan. Other considerations, obviously, we can talk, and we'll probably talk tomorrow. If this continued weakness develops, we've already 17 minutes into this, but there's a number of strategies that you can start taking into account to hedge your portfolio or even take advantage of a down market. Probably enough for today, though. Bottom line, you have time right now to consider your actions and be prepared if this condition should turn into something more. Now, we've spent most of the time talking about the downside potential and the risk there, but also consider, as we wrap up, that you could very much have a flushing, an exhaustion pattern come in, and then 2 days from now we could very easily see ourselves 3/4 of the way back up to the top of the range. So don't go all in bear. That would probably be a mistake, especially considering just how long the bulls have ruled and how poorly bears have benefited from pullbacks in recent years and months. But you need to be prepared. You never know when it's going to break down and turn into something more. So enough for today. If you're getting benefit from what we're providing you here each morning, we greatly appreciate you like us on YouTube, and then of course share what you have found here with your trading friends and community. Obviously, we model all these activities in our portfolio and options trading chat room. More information available at this website, and goes into great detail about what we do there. Performance matters, and obviously we feel good about the performance we've had just year to date, even considering the kinds of conditions that we've been dealing with the market. Disclaimers as always. Hit the pause button if you need more time to review this. And we greatly appreciate you each and every trading day in the Falcon Global Trading community. Good trading.